Welcome to the basic financial analysis, ratios, and performance monitoring in microfinance banks. This is part 2, lecture 4 of the topic. In our last lecture, which is lecture 3, we discussed the customer's balance sheet. Today, we are discussing the profit and loss account. At our next lecture, we will be looking at the cash flow. All this analysis still centers around the customer's account books and not the bank's book of account. The microfinance institution also maintains its own balance sheet, profit and loss and cash flow statements. We will discuss this in further lectures. Now, what is the income statement, also known as profit and loss? The profit and loss account shows the state of affairs of a business over a particular period. The analysis used is a representation of the record taken for assessment. What does an income statement do? It shows if a business is making a profit or a loss. It shows the position of the statement of the business. It reflects on the business, covering a particular period in time, i.e., daily, weekly, monthly, yearly. It helps clients understand the income and expenses they make and incur. The profit and loss components and breakdown include, but are not limited to, sales, costs of goods sold, gross profit, operational expenses, operational profit, family expenses, other incomes, monthly disposable funds. The profit and loss have three main components, namely, revenue, expenses, and the profit or loss. The revenue part takes cognizance of the total sales made for the day, where we deduct the cost of goods that has been sold, which gives up the gross profit. The next is the expense component, which sees us deducting all operational expenses from the gross profit to give us the operational profit. The last component is the profit or loss determinant. We do both addition and subtraction at this stage because we deduct all family expenses from the operational profit before adding other income to the operational profit to give us the monthly disposable income. Note that adding other income to your profit and loss statement must come with proof. Now let's talk about how to calculate sales and profit and loss. In order to achieve this, you must understand some basic principles. Understand sales and understand how it is being calculated when assessing your customer's profit and loss. What is sales? This is cash generated through quantity of goods or services sold or rendered to your various customers. This is denoted by this formula. Quantity sold, QS, multiplied by selling price, SP, which equals sales. How is sales calculated? Sale is computed with result gotten from records or declaration given by clients. Sales can be verified by cross-checking information from different sources. Sales record can be complex to ascertain because of its unreliability. Sales over a period vary from time to time. Some days might have good sales while some may have bad days. Verifying and cross-checking sales. Compare sales report gotten from different sources. Calculate sales based on client's record and declaration in terms of money or unit by daily, weekly, monthly, quarterly, biannually or annual sales. Cross-checking and sales. To confirm sales, you need to learn how to cross-checks for accuracy. Let's take these scenarios as an instance. We all know 7 days makes a week. If we exclude Saturday and Sunday, it gives us 5 days. So let's use that as an example. Based on a 7 days a week analysis, assuming 4 weeks makes a month, we have the analysis below. Client daily sales equals 10,000. Client's weekly sales equals 10,000 multiplied by 7 days equals 70,000. Client's monthly sales will then equal 70,000 multiplied by 4 weeks, which equals 280,000. The next thing we will be discussing is how to calculate the cost of goods sold. The cost of goods sold is the value of the purchased goods sold by the client to his or her customer during a specific period in time. It is very important you understand that cost of goods sold by the client is also the same as cost of goods purchased by customers. We denote cost of goods sold by the formula quantity sold, QS, multiplied by purchase. Let's look at the below example. A client purchased 1,000 pieces of bags for 10 each. He sold the 1,000 pieces for 15 each. What is the cost of goods sold? When calculating cost of goods sold, the purchase price of 10 is the determinant, not the sales price of 15. Remember, total sales 15 and cost of your purchase is 10, giving you a profit of 5. Note that calculating cost of goods can be way complicated when you have more than one product. At such point, we take cognizance of calculating the gross margin for the cost of goods sold. Calculating gross margin for multiple products when analyzing cost of goods sold, still using the diagram above. Note that selling price equals 15 multiplied by 1,000 equals 15,000, purchase price equals 10 multiplied by 1,000 equals 10,000, profit equals 5,000. Therefore, gross margin equals gross profit equals 5,000, which equals 33.3%. Using the below formula, selling price minus purchase price, divided by sales price, which equals 33.3%, as you can see, we arrived at the same figure. the above is for one type of product, hence we used the gross margin. If the product is more than one, then we use the weighted gross margin. Let's look at the example below and calculate the weighted gross margin. Study the diagram, cross-checking our result above using the formula we have. Gross margin equals gross profit divided by sales prices, which equals 4 bags 5,000 on profit divided by 15,000 selling price, making a total of 33.3%. For shoes we have 1,500, weighted gross margin equals 4 shoes, 1,500 on gross profit divided by 10,000 selling price, making a total of 15%. Having this information, we proceed to get our weighted gross margin. To get our weighted gross margin, we have share of sale in bags, which equals 15,000 divided by 25,000, representing a 60% plus share of sale in shoes, which equals 10,000 divided by 25,000, representing 40%. The final calculation for the weighted gross margins comes with adding our gross margin of bags multiplied by share in A, plus gross margin of shoes multiplied by share of B in sales. Adding all this figure together, we get a 26. Using the formula for cost of goods sold, we have sales multiplied by 1 minus gross margin in bracket for one products and sales multiplied by 1 minus weighted gross margin in bracket for more than one product. To conclude with calculating the cost of goods sold, we move to solve the above. Cost of goods sold, which is 25,000 multiplied by 1 minus 0.26 in bracket equals 18,500 naira only. The 18,500 naira only is the cost of goods sold for both products. Remember, if the product is one, we use the gross margin. If the product is more than one, then we use the weighted gross margin. Having understand how the cost of goods works, we move on to the operational expenses and the profit and loss. Let's look at the items in the operational expenses. But first, what are operational expenses? These costs are not directly related to sales or income but are fixed payment for specific purposes. They include but not limited to salaries, rent, utilities, transportation, communication, taxes, owner expenses, royalties, financial and other cost. Remember, in calculating operational profit we use gross profit minus operational cost, which equals operational profit. Now let's talk about other income and the profit and loss. How to calculate other income and expenses in the profit and loss account. First, we look at the other income. Other incomes are income derived from other sources that can be verified with proof by the microfinance institution before being added to the operational profit and other to show a relevant position of the client business in the profit and loss account. Family expenses. These are day-to-day family expenses incurred by the family but factored into the profit and loss account. Items include house rent, education fee, feeding expenses, clothing, transportation, health expenses, utilities and other expenses. Remember that for us to achieve this, we deduct family expenses and add other income. Disposable income in the profit and loss account shows the percentage of the customer's disposable income in the profit and loss account that is allowed by a particular financial institution for loan repayment installment. The percentage applied is known as a risk buffer, and it ranges from one financial institution to another and from particular percentage to another, i.e., 50% to 75%. The essence of this is to place the customer in the limits of his repayment capacity, as anything above the client's repayment will spell trouble for the MFB. To round up Lecture 4, let's take this example. A client requested for a 300,000 loan with repayment plan estimated at 60,000 monthly for 6 months. Using 50% as a risk buffer, he made a sale of 2,500. His gross profit is 2,125. The gross profit totals 375. Total operational expenses includes rent, 40,000, education, 23,000 only, clothing equals 5,000, transportation is 10,000. Health, 2,000 and utilities 7,000. He has a family expenses of 112,000. Using the formula below, 1. Find his disposal income. 2. Find the actual repayment capacity ratio. The repayment capacity of 60,000, which was initially given, divided by the disposable fund of 145 equals 41%. With the result above, the customer has the repayment capacity to access a 300,000 loan since the risk buffer is 41%, which is way below the 50% benchmark. We have now come to the conclusion of Lecture 4. Note, the income statement and the profit and loss account are used interchangeable. Also, the focus of this lecture is for microfinance officers to understand how to properly access a potential loan customer's loan request. See you in Lecture 5. Take these review questions to better help you understand the profit and loss account.